Alright, ladies and gentlemen, let us do question number 1. I'm giving you 5 minutes to try and read the question on your own. So let us do question number 1. Question number 1A says, so we are looking at A, discuss when the capitalization of borrowing costs on the new manufacturing machine should commence. And cease in the accounting records of Arthur Limited. Alright, so what we need to know, ladies and gentlemen, when we are looking at capitalization commencing and ceasing of borrowing cost, we know that capitalization should only commence when the three of the following are three are available. So capitalization must commence when all 3 of the following conditions have been met. So we are looking at 3 conditions, alright, which are: number 1, expenditure for the asset is being incurred. In our case, expenditure is being incurred on 1 September 2018. Then activities, number 2, activities to prepare the asset for its intended use are in progress. So we can see that it is also 1 September 2018. Then number 3, borrowing costs. Borrowing costs are being incurred, which is 1 October 2018 in our case. So as a result here, borrowing cost can be capitalized from 1 October 2018. Alright, then capitalization of borrowing costs should cease. So we are saying capitalization should cease when substantially all the activities necessary to prepare the asset for its intended use have been completed. Or when the asset is ready for use. In our case is 28 February 2019. So that is A. Then B is saying discuss the classification, measurement, and initial recognition of the loan from Bob Bank in the accounting records of Arthur. So we are discussing classification. All right. Then initial measurement, or recognition of the loan. All right. So ladies and gentlemen, here we are looking at International Accounting Standard number 39 and IFRS 32 and IFRS 9. So the question that we are having here is, does Arthur Limited have a contractual obligation to deliver cash to another entity? So we are saying Arthur Limited has a contractual obligation to deliver cash to Bob Bank. Therefore, the loan should be classified as a financial liability. All right. So in terms of IFRS 9, the financial liability will be classified as at amortized cost. So we are saying classified this financial liability should be classified at amortized cost using the effective interest rate method. All right. Arthur Limited will only recognize the liability once they become part to contractual provisions with Bob Bank. All right. So a liability will be recognized only from 1 October 2018 when Arthur Limited received the funds. Alright, so the mere fact that the amount was authorized or approved is like if you have got an overdraft which is authorized or approved, however the amount was not paid yet or was not yet withdrawn, you cannot do anything. Then number C, we are required to do journal entries relating to the investment in Polar Limited. Investment in Polar Limited in the separate books of Arthur. So as you can check here, they are saying on 1 September 2018, Arthur Limited acquired 200,000 ordinary shares. So we need a journal entry on 1 October. So 1 September 2018, we need a journal to record the investment that we entered into. So we are going to record, ladies and gentlemen, an investment in Polar Limited. So debit investment in Polar Limited. All right, 200,000 shares multiplied by the share price of 24 plus transaction cost that was paid, saying a broker's commission of 40,000 was paid, to give us 4,840,000. all right, then we credit the bank. We paid this amount, 4,840,000, paid for by us. So we are recognizing investment in Polar Limited, which is accounted for at fair value. So sometimes we can, instead of writing investment in Polar, we can say investment in or we can say investment at fair value through OCI, through other comprehensive income. It is an investment through other comprehensive income. So we are told that on 15 April 2019, Polar Limited paid a dividend of R1.80. So they are paying to us. We have to debit bank, which is 200,000 shares multiplied by R1.80, which gives, my calculator is giving me 360 here. The bank is in statement of financial position, statement of financial position, statement of financial position, the first one. Then credit dividends received, which is a profit or loss item, which 360,000, like this. Then on 30 June 2019, we are given the fair value of a share in Polar Limited. The fair value of a single share in Polar Limited is R26.50. So we will say there is an increase in the investment that we entered into. So we are going to debit investment in Polar Limited. Why am I saying there is an increase? We acquired it at 24, now is sitting at 26. So that is an indication that it increased. Then we credit fair value adjustment, which is an OCI item. All right. So how do we calculate the movement here? We say 200,000 shares multiplied by 26 rand 50 minus the original investment of 4,840,000. Don't make a mistake of netting the difference between 24 and 26, then you multiply by 200, because transaction cost on the on this transaction was capitalized, the 40,000, so you will leave 40,000 out, so you will not get the actual or the correct figure if you do that. So we have got my calculator is giving me 460 here, 460,000 as the difference as my fair value adjustment from these transactions. All right, so we are done with this question. They said indicate the debt. Journal narrations are not required, so you don't need to write that this is accounting for fair value adjustment, this is accounting for dividends received, this is initial recognition of investment. You don't necessarily need to do that because the question is specific about that. All right, then part D says disclose the above information in the following notes to the separate annual financial statements of Arthur Limited for the financial year ended 30 June 2019. Profit before tax. So we have got Arthur Limited notes to the financial statements for the year ended 30 June 2019. So you are doing these notes. All right, so the first note that we have, ladies and gentlemen, is profit before tax. Can you have note number 2, profit before tax? Profit before tax. Then profit before tax includes the following. Included in profit before tax are the following. All right, so we have income and expenses. So we have got income. All right, so as far as our income is concerned, ladies and gentlemen, it is known that we have received dividends. So we have dividends received from a subsidiary, which is 360,000, like this. Then we have expenses. This is the only income that we have. So we have expenses. Expenses, ladies and gentlemen, from the information that we have been reading in question number 1, we have employee benefits. Employee benefits. All right, which is made up of short-term, employee benefits, and post-employment benefit. Then we have got an asset, so we will have depreciation. We have net finance costs, net finance cost, which is as a result of total finance cost, less borrowing cost capitalized. So that's our profit before tax. So let us do the calculations and bring the figures here. So in doing the calculations, ladies and gentlemen, we can start with the simple thing that you need to do is say, what should we start with? Short-term employee benefits. So short-term employee benefits calculation. So this is our first calculation. Number one, what do you know about short-term employee benefits? We have got salaries. Other limited pays 1.2 million per month multiplied by 12 months, which gives us 1.2 by this gives us 14,400,000. All right. Then what else do we have? We have bonus paid. All right. So when you are reading the bonus issue here, they mentioned that other limited pays a bonus to all employees at the end of December each year, which is equal to 1 month's salary. So 1 month's salary is 1.2 million. That's our bonus paid, ladies and gentlemen. That's the bonus paid. Then, since our bonus is not paid on the same day as our financial year end, we are saying there is a provision that needs to be made. There is a provision that needs to be made. So prior year provision, ladies and gentlemen, prior year provision for bonus that was paid in December, we are told here that salaries will increase. So in July, the increase on 1 July 2018 was 6%. All right, 1 July 2018 to 1 July to 30 June 2019. Then from 30 June 2019 to 30 June 2020, we have got, so the increase on 1 July 2018 was 6%, and the increase 1 July 2019 was 8%. So currently we are saying, when exactly did we make this provision? So we made a provision based on what, ladies and gentlemen? So it must be provision prior year, provision prior year, we must reverse the provision for prior year, ladies and gentlemen. We are saying we made a provision last year on 30 June 2018 when we knew that the salary would be 1.2. So we are saying 1.2 million multiplied by, so it's 1.2 million multiplied by 6/12 because it's 6 months. Why are we saying 6 months? So from the last bonus that was paid in December, we have 6 months up to 30 June. That's why we are having that. So we have an amount of 600,000 which needs to be reversed. Then provision current year. So on 30 June 2019, we need to make a provision, but after increasing our salaries by 8%, so it's 1.2 million, 1.2 million multiplied by 1,08, which is an increase, multiplied by 6 divided by 12. So 1.2 multiplied by 1,08, to account for the increase, multiplied by 6 divided by 12, then we get an amount of 648,000. This is our bonus provision. So we looked at bonus paid, bonus provision, prior year, bonus provision, current year, and this is our total for bonuses. So this is your bonus cost in your financial statements. All right, ladies and gentlemen, you looked at that. Then what else do we need to have, ladies and gentlemen? We have got leave accrual. Leave accrual. So we have leave accrual. So as far as our leave accrual is concerned, we know that we are given leave for prior year. So we have got prior year leave, which should be accrual, which should be reversed. Prior year leave accrual, which should be reversed, is how much? 431,800. 431,800. Then, ladies and gentlemen, current year, ladies and gentlemen, as far as provision is concerned, for you to be able to understand, I will read. They are saying the following unused vacation leave days on 31 December 2018 were transferred to the next leave cycle. So last year, so leave accrual, current year leave accrual. All right. So for you to do this, you need to understand something. So I would open another page for you to see. This page, we are now saying, for me, we have got people who are earning 30% of salaries and wages. In 2018, these people carried forward 5 days on 31 December 2018. Remember, we are reporting on 30 June. So in 2019, these people were entitled to, so they are entitled to 24 days per year, but up to 2019, they have only worked 6 months. So when I are saying they only worked 6 months, we are saying from December 2018 to June 2019, we have 6 months. So 24 divided by 12, it gives us the leave days per month. So the leave days per month is 2. Multiplied by 6, so they will be having 12. 12 plus 5, ladies and gentlemen, is giving us 17 minus taken. So we are told here that they took an average of 6 days. So the balance that they do have is 5 plus 12 minus 6, which is 11. 11. So we must provide for 11. Then those that are earning 20%, we are told here that for employees who earn 20% of the gross monthly salaries, 3 days were transferred. So they had 3 days in 2018. Then these employees also had worked 12 days up to June. Then how many days did they take? They take an average of 7 to give them 3 plus is 15 minus 7 is 8. Then we have got those who are earning 50% of the salaries and wages. The remainder of the employees had no unused vacation leave, so they had 0. They qualified for 12 from this period, and they took an average of 8 days. So they are left with 4. So when you are making a provision now, ladies and gentlemen, you will say, what is my monthly, my annual salary? So we will say 1.2 million. That's my monthly salary for those who are earning 30% first, multiplied by 1,08. They will take this leave when the salary have already increased. So multiplied by 1,08, multiplied by 12 to make it 12 months salary, multiplied by 30%, multiplied by 11 divided by 252 days. Then we get an amount. So if we say 1.2 million multiplied by 1.08 multiplied by 12 multiplied by 0.3 multiplied by 11 divided by 252, we get an amount of how much? How much are you getting? I'm getting all right, let me recalculate again. We are saying 1.2 million multiplied by 1,08, right? 1,08, so multiplied by I'm getting 203,657. 203,657, and those who are earning 20%, so I will say 1.2 million multiplied by 1,08 multiplied by 12. 12 is 12 months in a, remember 1.2 is per month, 1,08 is the increase that is expected, multiplied by 20% multiplied by 8 days over 252. 8 days over 252. So 1.2 million multiplied by 12, we get 14.4 multiplied by 1.08, we get 15 multiplied by 0.2, we get that, multiplied by 8 divided by 252, we get an amount of 98,743. Then 3, we have got people who are earning 1.2 million per month, which is increased by 8%, multiplied by 12 to make it an annual, multiplied by the remainder is 50%, multiplied by 4 days, they have 4 over 252. All right, so if we say 1.2 million multiplied by 1.08 multiplied by 12 multiplied by 0.5 multiplied by 4 divided by 252, I'm getting an amount of 123,429. Then the total is 425,829. That's what the total I'm getting, ladies and gentlemen, as a leave. That's the total that I'm getting. So now I want to be able to now record this. Initially last year it was 431. Now it is reduced. So one would wonder now what happened, but that's none of our business. We are only worried. We are only worried by. All right, so that's the figure that I'm getting. So I'm going to say it's a total of 425,829. 425,829. Prior year in brackets, current year outside brackets. So this is my total short-term employee benefits from top to bottom. So I'm now adding I'm getting a total of 15,462,029. That's my total short-term employee benefits. I don't know how much you are getting yourself, but that's the total I'm getting. So now I go to my question, which they actually gave me. The note, I know short-term employee benefits is 15,462,029. That's my short-term employee benefits. Then I move from there, ladies and gentlemen. I have got post-employment benefits. Post-employment benefits, ladies and gentlemen, refers to the amount my employer is contributing, which is 1.2 multiplied by 12 multiplied by 7.5%. Someone will ask, what about the amount that I am contributing? It is already included in your salaries and wages, so no need to include it again. Alright, so I'm getting 1,080,000. If I take a total of this plus 15 462,029, it's giving me 16,542,029, like this. All right, then I'm proceeding, ladies and gentlemen. So now I have calculated the short-term employee benefits. Now I want to look at borrowing cost capitalized. Borrowing cost capitalized. So let us look at borrowing cost. Capitalized. Alright, so as far as our borrowing cost, ladies and gentlemen, is concerned, it must not be difficult for us to calculate it. Why should it not be difficult? For a simple reason that we received money. The money that we have received, ladies and gentlemen, amounts to how much? The money that we received amounts to how much? Alright, so when you are calculating that, we received a total of 9.6 million. So because we are received 9.6 million, we are saying did we receive it as a lump sum? The answer is no, we did not receive it as a lump sum. So how much did we receive? Initially here, if you check, we received 6 million. So we have got 6 million. Alright, multiplied by from October, so multiplied by 12%. They said it's at 12%. So it's October, November, December, January, February, up until the day we actually received another amount of money. So we have got 5 months multiplied by 5 over 12. So if you say 6 million multiplied by 12% multiplied by 5 divided by 12, you get 300,000. All right, we cannot capitalize for 3.6 million. Why? Because we are saying 3.6 million, ladies and gentlemen, it was only paid on the day that the asset was ready, so it cannot be capitalized. So what should we do next? Now we need to see the total interest that was actually supposed to qualify, the total interest for the year. Our year end is June, so we are saying so if we are looking for capitalized is this, then total interest, ladies and gentlemen, should be the 6 million multiplied by 12% multiplied by 5 over 12, which is 300,000, plus 3.6 million plus 6 million. Now from March, April, May, June, 4 months. So multiplied by 12% multiplied by 4 over 12. That's how you do it. So now you have got a total of 9.6 million multiplied by 0.12 multiplied by 4 divided by 12. Then you get an amount of 384,000. Alright, if you add here, you are getting 684,000. So this is our total interest. So we can go here and also disclose this. So we have total finance cost of 684,000. Yes, sorry. All right, 684,000. Then borrowing cost is 300,000. Then net finance cost, our net finance cost is 384. All right, so we can now calculate also depreciation. So the cost of the asset is 9.6. So we want to calculate depreciation. 9.6, which we have used, plus 300,000 to give us 9.6 plus 300 is 9.9 million. And they said minus residual value of 250. That's residual value of 250 divided by or multiplied by 4 over 72. 72 is 6 years in months. So how much do we get if we say 990,000 minus 250,000 equal to multiplied by 4 divided by 72 equal to 536,111. 5 so we have got 536,111. all right, we need to remove the bracket. Sorry, I'm just showing these are expenses, so we just need to remove the bracket. It's 536. So this is the profit before tax. You can also do now property, plant and equipment. And equipment, property, plant and equipment note. So in property, plant and equipment note, you see that you have got carrying amount at the beginning of the year, which we are saying the asset was not there. Then you have got cost, which is not also there. Accumulated depreciation, which is not there because the asset was completed in the current financial year. Then we have additions. All right, our additions is 9.6, the total amount we have borrowed. Then we have borrowing cost, capitalized, borrowing cost capitalized of 300,000. Then we have depreciation. Depreciation we calculated, we said is 536,111, like this. Then we have carrying amount, at the end of the year, which is as a result of cost less accumulated depreciation. Cost we said is 9.9 thousand. Accumulated depreciation said is 536,111. So our carrying amount at the end of the year, ladies and gentlemen, is 9,363,889. all right, so that is the next part that we wanted to do. We say this is now 3 because profit before tax we said it was 2. Then we proceed, ladies and gentlemen. What else do they say they want to see? Related parties. All right, related parties. So as far as related parties is concerned, ladies and gentlemen, which is our note number 4, related parties, we need to identify relationships. So we need to identify relationships first. Then after identifying relationships, we need to look at transactions that happened between related parties during the year. Then after that, we need outstanding balances. So related parties, we know that Polar, so 4.1, we know that Polar Limited is a related party. To Arthur, as it is a subsidiary of Arthur. Then Bob Limited or Bob Bank is a related party. Is a related party of Arthur because the CEO of Arthur Limited is the father of James Lubisi, the financial director of Bob Bank. So that is the first thing you do. You identify relationships. So we are saying relationships can be caused by companies which are in the same group, companies which are associates to the same investor, companies which are joint ventures to the same investor, and we also need to look at relationships that comes as a result of key management of companies. So if your wife is a CEO at Eskom and you are a CEO or you are the owner of your own company and you transact with Eskom, you become a related party because your wife is actually at a position of influence. Then we have got 4.2. So transactions that happens during the year. Transactions. We have got purchases of lands. Purchases of lenses from Polar. Purchase of lenses from Polar of 1.6 million. Then we have got finance costs. Finance costs incurred on loan from Bob Bank. How much is it? Is 684,000. Then we have dividends received from Polar, which amounts to 360. We also do have loan from Bob Bank of 9.6. So these are related party transactions that happened during the year. Then we are now looking at outstanding balances. So when you are looking at outstanding balances, that is 4.3. Outstanding balances. All right. So as far as our outstanding balance are concerned, we have loan and interest. So loan of 9.6 million plus interest of 684,000 was not yet paid. So if you add this 9.6 million plus 684, you get 10,284,000 as outstanding balances. Then you also need to include the fact that the transaction between Arthur Limited, Paula and Bob were entered into at arm's length. So all transactions between Paula, Bob, Bank and Arthur were at arm's length. So that is how you actually finish this particular question. So ladies and gentlemen, we are done with this particular question. So this is the paper that they wrote in 2019 October November, which is fairly fair. A person should actually be able to get a pass in this regard. Thank you so much. We are done for 2018. In case you have a question, you can actually call me on 078-276-4555. So that's my number, and the number is also on WhatsApp. Thank you.